Hello and welcome back to The Note, coming to you from New York, where we've had another very dramatic day of trading. In the case of the oil price, it's shot up once more, even though the only really substantive news on oil for the day was decidedly negative, showing that there were still very high inventories here in the US. Instead, what pushed the oil price was the dollar. As you can see here, it dropped very dramatically today against its main trading partners. And the main reason for that, we can show you in this next chart, was because of the main economic release of the day, which was the services ISM or PMI data, based on a survey of supply managers where any number above 50 shows expansion and any number below 50 shows the risk of a recession. As you can see, the equivalent number for manufacturing has been signaling very severe slowdowns for a while, but contrary to history, services has managed to buck that. It stayed very comfortably above 50. That led to the hope that as manufacturing is less important to the US economy than it used to be, services could actually go on and prosper even if manufacturing lapses into a recession. The latest numbers were worse than expected. They're still comfortably above 50, but they plainly challenge that notion. They add to the fear that services is going to be dragged down by manufacturing and therefore lead us into a recession here in the US. Now, that had its biggest effect on the dollar through the effect it had on expectations for the Fed. If we show you this next chart, which was derived by Bloomberg from prices on the Fed funds futures market, this shows you the chance that rates will be any higher than they are now come December of this year. And you can see that the odds are now more than 50% that there will be no rate rises at all this year, as far as the market is concerned. Bear in mind that the Fed is still officially guiding us that there will be 4 more rate rises this year. Now, this obviously puts a lot of weight on the testimony we'll hear from Janet Yellen to Congress next week. In the meantime, if you want a clear indicator of whether there is a recession risk here in the US, the unemployment figures will be more important than any others. So far, they emphatically do not bear out the notion that there is a risk of an imminent recession. We hear those data on Friday. If you have a surprisingly poor number, that would certainly strengthen the hands of those who are now betting that the US could lapse into a recession this year.